Question was, what are the downsides of getting a federal tax lien?
Well, there's a few complications. If you're trying to sell the property and you have enough money at closing, then you just get a payoff letter from the IRS. However, if you don't have enough money, the proceeds at closing to pay off the IRS completely, you have to get permission from the IRS and you apply for a certificate of discharge. So they will discharge this specific piece of property from the lien, but the lien will remain for other real estate that the taxpayer may own. And then when the borrower, the taxpayer wants to borrow against the real estate, they need permission from the IRS. It's called the lien subordination agreement, because the IRS has to give up their position to the new lender. They'll come in secondary to the lender that's contemplated, and the IRS will do it if it's in their best interest. So that's kind of a complication when you have a federal tax lien.
Now, it seems like there's a lot of going back and forth with the IRS. How would a person, or does it make sense for a person to do this themselves, DIY, trying to sell property if they have a federal tax lien? And
Well, it's like everything else. You can represent yourself in our legal system, but it's usually not advisable. You may get through it, but the problem is a lot of these closings are time sensitive. And if you don't do it on time, you can lose your buyer if you're trying to sell.
Right.
If you're trying to get a loan, it may delay it too long. However, people can do it themselves. I don't recommend anything having to do with the IRS that you do it on your own. But sometimes
It's possible.
Yeah, everything's possible, but not recommended.
Advisable. Right. Understood. And so question we had asked following that was, what if someone wants to borrow money but they have a federal tax lien? How would it affect their ability to borrow or their credit?
Well, in April of 2018, the IRS debt was no longer reported to the major credit bureaus.
Okay.
So it's no longer a problem. However, I do tell my taxpayer borrowers not to forget to list all of their debts, because they could actually be committed a crime if they apply for loan and fail to mention especially substantial IRS debt. So that can cause the lender to decide not to lend the money. So that could be a complication.
Right. And so that would be an issue whether or not there's a tax lien on the record. They might owe a debt. Maybe it's under the amount that the IRS would need to file or want to file a federal tax lien. They still have to
Right.
disclose the debt.
Oh, yeah.
On the-
So that's more of a non-IRS question, but it's related in that people want to get the loan, so may be tempted not to mention the IRS debt.
Right. Okay. So another question we have is, we get this question a lot, so it's pretty common. People hear about being able to settle their IRS debt for pennies on the dollar, just make an offer to the IRS. Can they accept less? Can they get rid of, a portion that they owe?
Well, that's actually the number one question I get. Almost everybody says, is there any way you can lower how much I owe? Can you get rid of the penalties because they're ridiculously high? Or can you just get rid of the interest? And the pennies on the dollar concept is really something called offer in compromise. And the idea behind the offer in compromise, if you offer a set amount of money and the IRS accepts it, the rest of your debt is forgiven, so long as in the following 5 years you filed your tax returns on time and pay the taxes. However, there's three factors, generally speaking, there's three factors that the IRS will consider in granting the offer in compromise. Number one is a 10-year collection period that the IRS has. The longer the IRS has to collect, the less likely they are to accept a low offer, because their idea is, are you going to offer us as much as we can collect from you in the next whatever time is left on the 10-year clock? The second factor is that you have to offer the equity in all of your assets, and then for real estate, they will discount the fair market value by 20%. So let's say you have a home worth $500,000. Well, for the IRS, it's really only worth $400,000. Knock off 20%, and then if you have a loan, let's say of $300,000, that $100,000 equity you have to offer that in the offer in compromise. Now, there are special circumstances that may allow you to, in spite of the fact that you have the ability to pay, like old age, illness, and other situations that the IRS may consider. But that's a very difficult thing to do. I hear a lot of what I would call misleading advertising, the Fresh Start program, or we can settle for pennies on the dollar, and they tell people without even qualifying to saying if you qualify. And a lot of people have been disappointed when they really can't get approval of an offer in compromise.
So they've paid some company to help them submit an offer in compromise, thinking that has a pretty good chance, but then they get denied. But they've already paid several $1,000s to this company to
Right,
assist.
and of course, who knows how their contracts are written, but they probably have it in the contract if you qualify.
Right.
And say, well, you don't qualify, so let's do something else for you.
Right. And what we like to do is kind of talk to a taxpayer about their specific situation and explain what are the criteria. You covered two of them. The third third point.
Oh, yeah, and
cover
for
it
an
now.
offer in compromise, it's a 10-year collection period. Longer the period left, the less likely the IRS is to expect a low offer. Then you have to offer the equity in all of your assets, which usually disqualifies people from even trying. Well, they may not qualify because their equity may be more than their debt. And then the final one is your net income after all business expenses and reasonable and necessary living expenses times a multiple of 12. And so you add all that up, and a lot of people don't qualify.
Right. So there are some people that can qualify, but it's a specific niche of people that fit those specific criteria. Maybe their income is not high, or they don't have a lot of assets, and maybe there's not a lot of time left on the collection statute expiration date. So
Yeah, I tell people, oh yeah, I once had a gentleman who owed $70,000. I settled for $500, but he was retiring. He had stage 4 cancer, and he didn't have a home. So
right.
in that case, it worked very well.
Yeah. So there's definitely cases where we have successfully. We've done a lot of them, offers
Yes.
in compromise, but they're not. It's not as easy as other people make it
But
seem.
you know, sometimes even though you can't make a low offer, I had a businessman who owed $213,000, and after all was said and done, he qualified to reduce it to $93,000. Even though he didn't get rid of all of it, he was very happy because it dropped from $213,000 to
so
$90,000.
greater
So
than 50%
he
savings.
considered that very successful.
No, that's great. Great example. All right, and so we talked about the good offer and compromise candidate. A couple of the special circumstances could be illness. So in addition to those three criteria, there could be extenuating circumstances. Someone maybe has a prognosis of a medical prognosis that means, and the IRS might take that into consideration.
I have a case that we submitted, and we think they have a pretty decent chance. The husband is in hospice care. The wife has a lot of memory problems, and she's working independently, but she's not making a lot of money. And so these are the types of things that the prognosis is not good for this couple. And they have some savings, but they made a decent offer, but nowhere near where they owe. But that one, I think, has a decent chance of being approved because of those special circumstances.
Right. Okay.
Hey, real quick. Hi, everybody. I'm Ruben Ramos. I'm also a son of attorney Tony Ramos. Hey, so I just wanted to, let me adjust the
Sure.
picture real quick.
Go ahead.
Tony, you are off the image. I know you're trying to,
Yeah.
but I'm going to zoom out a little bit so you can both be on screen. And maybe y'all can look,
Look at that screen.
well, camera.
there, okay.
Just because, so people, I don't know what I'm saying. Anyways, I'm going to zoom this out a bit, but you all keep talking, and I'm just going to adjust this.
Okay.
All right.
Yeah.
All right, next, so another thing that's available, some people, if they don't make a good candidate for offer and compromise, is currently not collectible status. That's one option. There's
Right.
partial pay installment agreement, a couple of others, but let's talk specifically about C&C status, currently not collectible.
Okay, so currently not collectible status means that currently, at this time in their life, they can't even afford to meet their living expenses. So if you can prove that to the IRS, then they'll put you on zero payments until you file future tax returns, which indicate that you can afford to start making payments. And so they'll monitor your returns every year or every 2 years in that case. Also, this taxpayer might also qualify for an offer in compromise, but it's a lot more work and my fees are higher. But a lot of times they're going to be able to have no payments until the 10-year statute of limitation runs out. So they reach the same place, actually better because they make zero payments, whereas the offer in compromise usually requires some kind of payment. So it just depends. It's a fact-specific situation.
Okay, yeah, that makes sense. And so similarly, a partial pay installment agreement would kind of be in there, except maybe that's for somebody who makes a little bit more than the threshold to meet
Right.
currently not collectible status, right?
But just like the currently not collectible status, you have to prove to the IRS that you cannot pay enough to fully pay the IRS debt within the statute of limitations. In that case, we apply for a partial payment installment agreement. The good thing about both currently not collectible status and partial payment installment agreement is the 10-year statute keeps running. It doesn't slow it down.
Right.
And so that's often an option besides a full pay installment agreement.
Okay, that's great. So I know I get a lot of phone calls where people are asking to, they agree with the debt that they owe, but they've been charged a bunch of penalties and interest from the IRS, and so they ask, how can I get rid of the penalties and interest?
Well, you actually have to do it indirectly because the IRS will not eliminate the interest. So penalties, you can attack penalties in 3 ways. Number one, you can't afford to pay them. So you would do an offer in compromise, a currently not collectible status, or even a partial pay installment agreement, where you don't really mention the penalties, you just end up not paying them. When you want to try to abate the penalties directly, you normally have to have reasonable cause. Something beyond your control, such as a serious illness, that caused you to fail to file your tax return on time or to pay it on time. Short of that, there's another option called the first-time penalty abatement. For any tax period that the 3 years immediately preceding the year in question, the penalties for the year in question you're trying to remove, if you had no penalties of any kind for the 3 years before that, that's called first-time penalty abatement. And sometimes they can be almost half of the total debt. So it can be a very beneficial thing, even if you don't have reasonable cause.
Okay.
Also, people sometimes pay the IRS, and then they realize later they could have removed the penalties. In that case, we have 2 years from the time they paid it to ask for a refund, if you can prove first-time abatement or reasonable cause abatement.
Okay. Now, if someone was, I've had people ask or call in and talk about their case, and they've already paid the IRS, and I hear a lot of people say, "Oh, I paid the oldest ones first." What would you say about that?
Well, somebody's asking me, I owe several years ago and current year, which one do I pay first? I always advise them to pay the most recent one first because the older tax years may have maxed out their penalties because there's a failure to pay penalty after 5 months. That one usually gets maxed out immediately. But the failure to pay penalty can go on for 5 to 10 years. If you're not in a payment plan, it's 0.5% per month of the tax due. But once you get into a payment plan, it's a 1/4% per month. And the first one maxes out like in 4 or 5 years, and the other a lot longer. So that's I forget what was your question. I think I forgot the question.
So the question was, let's see, what was I asking? I was asking about.
That's okay. You
Yeah.
forgot the question. I forgot the answer.
Yeah, anyway.
Let's move on.
Well, I don't know if you already answered this, but what about the interest? Can they get rid of interest?
The IRS will not get rid of interest. It goes with the tax, the interest on the tax, or the interest on the penalties. But like I say, offer in compromise, partial pay installment agreement, currently not collectible, all those indirectly get rid of the interest.
I see.
but not
Okay.
directly.
Right, not directly getting rid of the
Correct.
interest. Okay, that makes sense. Get a lot of people calling in who get a letter from the IRS saying that they have an appointment with the IRS at a certain date. They need to go and maybe bring some records. Or they're nervous. They don't know. So, what would you advise somebody who has an appointment with the IRS and they don't know exactly what they're walking into?
To begin with, you don't get a notice of appointment unless a revenue officer is handling your case.
Okay.
And a revenue officer usually takes the larger cases with higher debt. And they're the most powerful and aggressive collectors in the IRS. So if you get a notice of appointment, you have to be aware of what you're walking into. And the notice of appointment usually is accompanied by a list of items you're supposed to bring to the appointment. And that's on a Form 9297. If you fail to bring what they ask, they often do is issue you at the meeting a letter 1058, a final notice of intent to levy with your right to a hearing, which means that if you don't appeal that, the IRS can levy your bank account, garnish wages, seize property within 30 days. But in that case, I don't recommend you go on your own because you have very aggressive revenue officers and very lenient revenue officers you just don't know. So if you're going to if you get a notice of appointment, I recommend you hire counsel for it.
Right. Yeah, great advice. And so if they get one of those notices, what if they just ignore it and don't attend the meeting?
Well, if they don't attend the meeting, they'll probably get in the mail a letter 1058 that they'll have 30 days to appeal the threat of levy. If they still ignore it, their banker may call them up and say, there's no more money in your account. That's the shocker right there. And if your business, especially, because there's a lot of business handled by revenue officers, you may not be able to make payroll. And now you're in a pickle, so I don't recommend just ignoring it. You can always call and try to extend the date, reschedule the date, tell them you need more time. Or if you show up unprepared, you can tell them, look, I need to hire a lawyer, and they'll usually give you a week or two to hire a lawyer. So just don't ignore it. That's
Okay.
my advice.
Yeah, bottom line, don't ignore the IRS, don't ignore those meetings. That's great. So if they miss, let's say they get that letter 1058, there's a 30-day deadline
Right.
on that. And for whatever reason, we've had people who miss that deadline. What happens? What are the consequences of missing that deadline? I know you've already talked about it, but specifically, LT11 or letter 1058, same sort of thing, just from two different sources. If they miss that deadline, what happens?
Well, like I said, the revenue officer, if they're being nice to you, they can call you up and say, if you don't do something, I can levy your bank account or seize your property.
So what does it
That
mean
sort
to
of-
levy? Well,
Levy means seizure. So they levy your bank account, they seize your money. Although the bank has to hold the money for 21 days before they send it to the IRS. So that gives us some time to negotiate with the IRS. If it's going to shut down your business, we can often get money back. I had a case like that a month ago where the levy was for $160,000, but we showed the revenue officer that my client was acting in good faith, and he allowed him to keep $100,000 of the 160.
For
So
operating expenses of the
even
business.
after the notice of levy went out.
Right.
So it's very serious, but oftentimes something can be done to alleviate the stress and the difficulty of running a business or just paying your living expenses.
Okay, great. So yeah, I mean that's a lot of it. I mean, we've had a whole variety of different types of clients and cases come in through the doors over the years. What are some standout examples or cases that you can
Well,
think of?
I had a gentleman a couple of years ago that built houses and apartments, but he didn't keep very good records. But what he did have was contracts, and he got paid on all the contracts. So apparently, he had some kind of proof. But he would take cash out of the bank and just pay his workers with cash with no receipts. And he didn't keep mileage for records for mileage and other things that most businesses would do. So he grossed a lot of money, and the IRS sent him a notice of deficiency for $1.3 million. So I met with the client and I told him, under the Cohan rule, you can, if it's logical that you incurred labor costs and materials, and you have some proof that you've been in business, that we can oftentimes get credit for those expenses. And so what we did, and you helped a lot on that, did some research on what is the net profit in that type of business. And we got the IRS attorneys in the tax court litigation to agree to apply a net income, a net profit to the gross sales. And we're able to combine the Cohan rule and this sort of creative negotiation to reduce the debt from 1.3 million to $120,000.
Yeah.
So even if you don't have great records, all is not lost. There's sometimes you can do something good about, even with that situation.
Now, in that situation, was that an audit? Was that during the middle of
Yes.
an audit? Okay.
So what happens a lot in the audits, I tell my clients, the toughest part of an audit is the examiner. After that, you go up to an appeals hearing or to file a tax court petition. And I like to go to tax court because the attorneys don't want to try all these cases. They're overwhelmed. And so anything reasonable usually wins the day. So even if you didn't have good records, what I found out, I help a lot of construction industry subcontractors. And a lot of them don't have good records. They just know how to make money and get the work done. But they often contract with general contractors who will say hire a framer or a painter or a foundation or a roofer or something, the specialty of the subcontractor. And they'll have much better records. Here are all the invoices the subcontractor sent us. We have all the specs of the job. And you can sort of reverse engineer how many workers, how many days, where the project was, so you can reestablish mileage. And I had a client about 6 or 8 months ago who didn't have great records. So I told him, go back and get together with a general contractor. And he put together, from whatever records he has, a great number of projects. And I was able to reduce his liability by $276,000. And again, was a recreation of logical expenses that seem reasonable. I think it was a painter. Somebody had to paint all these facilities, and he got paid for the work. So with those facts, you can often do a lot of things.
Right. And in that case, when you're dealing with the first stage, you're dealing with the examiner.
Right.
You were saying it's a lot easier once you get past that stage because the examiner, they're going to go by the book, right? And so
Right. They don't like this Cohan rule and
Right.
creative restructuring of expenses. You'll usually get an unfavorable notice of deficiency from that process, and then you can go to tax court.
So if
First
you get
can go
denied when you're trying to defend an audit, you get denied with your evidence. That's not the end of the road.
No, as far as I'm concerned, it's the beginning of the road because we've been very successful, especially in business audits, using the processes I've discussed.
Right. Okay. Excellent. Well, it's good. I think we covered a lot of material this time, and so
Worked out some technical stuff.
Yeah.
We'll be better prepared for next one, but
Well, that was
That's
good.
good.
Well, I appreciate your time going over these.
Yeah, happy
Any
to
other
do
last
it.
remarks?
And yeah, last remarks. We give everybody some free advice. So if you have questions, we try to be generous with our information. Obviously, we can't give everybody a free consultation. Well, we do give everybody a free consultation, but ongoing advice we'll start to charge. But you'll see, we're very liberal with our advice because sometimes people just need information to make an informed decision on whether to move forward with us.
Yeah, so reach out. If you do need to contact us, you can reach us at tonyramoslaw.com/contact. There's a form there you can fill out, submit a question, and we'll get back with you.
Thank you all.
Oh, yeah, and last legal disclaimer, it's not legal advice. This is for entertainment purposes only. We weren't talking about specific case details, but you can reach us to discuss, your specific case.